Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the technical analysis and double bottom trading strategy.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss technical analysis. Technical analysis is a very controversial topic, especially among the quants. Firstly, what is the technical analysis? So we will have a short definition. So the technical analysis is an analysis methodology for forecasting the direction of prices through the study of past market data, mainly price and volume. So we do not use any fundamental data, any alternative data, any earnings call or nothing like that. We are trying to forecast the price movement from the prices alone. We have a new article related to technical analysis. We have a new technical analysis report in Quantpedia Pro. Plus, we backtested the double bottom country trading strategy that I would like to show you, and that's the reason why we are discussing technical analysis at the moment. What is the point of view of the quants? So the technical analysis is an astrology for men. So most of the market technicians believe that the prices currently contain all information about any asset. It's probably very oversimplified assumption. The market is much more complex than that. Sometimes the fundamental analysis seems the same or have the same point of view, so you cannot use the price, but you can use only the fundamental analysis to predict the future directions, etc. I mean, the markets are probably driven partly by fundamentals, partly by psychology and prices. It will probably be unwise to overlook technical analysis as just some hocus pocus, but technical analysis has been really evolving. Slowly and surely, the quantitative analysis that's using the statistical theory has taken over. So yeah, we can use some ideas from technical analysis like patterns, indicators, etc. But we use them in a quantitative fashion, so it means we do the rigorous statistical testing, etc. You can say that the quantitative analysis has its roots in technical analysis, but it moved past the technical analysis just itself. If you are interested, you can recommend readings, classical introductory books, Japanese candlestick charting techniques, or encyclopedia of chart patterns. There are a lot of free information all over the internet. Technical analysis was founded in Japan in 1600s, so in 17th century. Most general things is to look in charts and look for supports and resistances in prices. So how does it look like? Suppose we have a chart like that. So here it's, I don't know, price of some stock going down, then up and down and up and down. And as you can see, each time the stock bounces, it bounces from the same level. We can call this level the support. If you have multiple bounces for the same level, we can expect that there is a strong buying pressure at a price around $51. So once the future price once again moves to around $51, we can expect that there will be some significant price action. The price can bounce from this support level, or it can get through the support level, and then it usually goes very strongly in the direction in which the price crossed the support level. But at the moment, the support level is around 51 or 51.5 US dollars. So this is how does it look like when there is a support and when there is a resistance. Is something similar, but on the other side, on the top. So the price goes up and then goes again down because there is a resistance at $49. So there are not a lot of buyers above the price of $49. So each time the price goes to $49, bounces back down. So this is how the resistance acts. Once the price moves over the $49, there is high probability that it will continue going up in this direction, but if it bounces hard. So this is how does it look like. There are other patterns that can, like candle price formations. The technical analysis uses also various indicators like exponential moving averages, MACD, RSI, etc., stochastic, and other like that. Technical analysis terms are usually easy to quantify, some of them, like indicators, momentum, moving averages, etc. And they are very often target of very hard academic research examination. A lot of the research papers also from our database are based on technical analysis patterns like momentum moving averages, reversal patterns, etc. So our screener contains a lot of the strategies based on this type of predictors, but there are some more vague terms in technical analysis that are really hard to quantify. Those are mainly the patterns like supports, resistances, double tops, trend lines, double bottoms, or more complex patterns like head and shoulders. What we can do with that? What we did over the summer is that we spent some time and we fought a little with some of these technical analysis terms, and we tried to quantify a tiny subset of the technical analysis patterns, and the patterns that were most interesting for us were the double bottom and double top. What is our methodology how to identify double bottoms and double tops? Firstly, we try to locate local lows and highs. So we use a rolling period of 30 days to look back and forward in a history and to the future around the potential local highs and lows, and we find and mark only local price charts highs and lows. So here we have an example. It's a MSCI Brazil ETF. In the chart we are trying to find what are the local highs and what are local lows. So local lows are in a green dot and local highs are in a red dot. So if we have a local high, so it's the highest high, and 30 days in the future, also in the past, there is no other higher price than this local high. We store all of these local highs and local lows, and then we look for potential double tops and double bottoms in these local highs and local lows. So what does it mean? The maximal distance between two local highs and lows is set up to 1020 days. Minimal distance is against 30 days. What does it mean is that we look for two highs that are at least 30 days from each other and maximally 1000 days among each other. And when they are close together, so when they are less than 2%, so when the maximum percentage distance between them on the y-axis is less than 2%, then we can say that that's double top. And here is also the double top. So what do double tops mean? So double top lines, they show the resistance levels, and double bottoms lines, they show the support levels. We also plot the trend lines. So we plot the support trend line and a resistance trend line. The resistance trend lines are built in a way that we take the last high, and when we look for another high, in the way that the resistance trend line can be formed. And also the same way we look for the last support, so the last low, and then we look for another lows and we try to build the support trend line. So that's the application. How does it look like in a report? Here we have a report with the setup. So you can select, or you can take any ETF, any third-party data that you upload into Quantpedia, and you can use the report, and you can plot the trend lines. You can plot the support and resistance levels, double tops and double bottoms for any price equity curve. What we can do with the report, the best way how to use the report is when you have some trading strategy that has a longer time frame, so like monthly or quarterly rebalanced. And in this case, you can use the report to identify support and resistance levels in which you can enter or exit some trading strategy, or when you can enter and trade on a signal from some trading strategy. That's probably the best way how to use the technical analysis as some overlay for a trading execution in this case. But we were also interested to see if we are able to build a trading strategy using the methodology that we have for double tops and double bottoms. So firstly, we try to build a long short forex trading strategy, but there was a signal based on bounces from the double tops and bottoms showed little success. If there was some potential, it was in the breakouts, as I mentioned before. Once the price breaks from the support level, so if the price breaks over the 51 and goes down, this is the breakout from the resistance formation. In a forex, the breakouts works well, or more or better. But we were not interested in a breakout strategy, so that's a form of trend following momentum trading. We already have a lot of these strategies in our database, so it would be just another momentum like strategy. So we moved to different market. Our second idea was to build a reversal trading strategy in equities. The why is that so the stock market naturally tends to grow, it trends in upside direction, so it would be fine to use the double bottom signal as a timing signal for a swing trading strategy that would buy country ETFs for a short period of time when ETF hits the support level. So we are looking for a reversal strategy. So we are looking for a strategy that uses our double bottom methodology, and once we identify the double bottom, we are using the ETFs and we buy on this double bottom level. So here is the investment universe of ETFs that we use in our backtest. We have a 24 country ETFs, mostly iShares. As mentioned before, the strategy is focused on finding the double bottom in country indexes, and we do not consider shorting index ETFs based on this condition. It doesn't make sense. I mean, usually the ETFs and equities, they trend fine to the top. So when we find two bottoms that are at least 40 days and we have at least 40 days space between them, this is the ideal parameter, and this is the ideal setting. Once the condition for double bottom is fulfilled, we buy the ETF. So once the price touches the double bottom, we buy the ETF. The maximum number of concurrent open positions is 4. Maximum portfolio average is 2 to 1, so 200%. So that's the usual average that you can obtain from brokerage. So the maximum weight of ETF in a portfolio is 50%. And then we can look for new double tops and double bottom formations once in a month. The trading decisions are executed on a daily basis. So we enter the and exit position on a daily basis. So we place a limit order for ETFs at the double bottom level, and we are waiting for price to touch the double bottom. We set up the fixed stop loss of 3%, profit target 6%, so we have a risk to return ratio 1 to 2. So what are the backtesting results? Here is how the equity curve look like. So we have a nice equity curve going up, Let me get back. The summary results are also the positive, so that we have an absolute return around 8%, Sharpe ratio around 0.5, annual volatility 16%. That's our backtest. You can easily clone the backtest. Here is the complete code. It's published on our webpage. It will be also published in our database, so you can freely copy the code, you can freely copy the methodology, and you can use the strategy as an example for a technical analysis strategy using double bottoms. So that's our take on technical analysis. Once again, if you are interested, you can check our trading strategy. We have also the report that's part of our Quantpedia Pro offering. I hope that you like this video about technical analysis. In case you like our content, I would be very, very happy if you subscribe to our channel. We have at the moment nearly 100 other videos about quantitative trading, algorithmic trading, market making, and all of the stuff related to trading strategies. And I hope that you join me in the next video. So thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.